Join the club of the richest 1%. By employing the strategies in this video, you can become rich and established and join the club of the richest 1%.
The knowledge and strategies in this video are rooted in Jacob Nayman's extensive experience, distilling more than a quarter of a century in his role as a leading investment and economic advisor to some of the world's wealthiest. Infusing your life with the financial strategies outlined in this video will enable you to achieve the most important goal of the 21st century: financial independence.
Stocks and bonds are the two main methods of investment in the stock market. Stocks, or shares, are a direct investment. You give money to the company and become a co-owner, with holdings proportional to the percentage of shares you purchased. As a shareholder in the company, you are also entitled to dividends paid by the company. When you invest in bonds, you are essentially giving a loan to a publicly traded company, corporate bonds, or to the government, government bonds. In return, you receive a guaranteed, predictable cash income which will be paid on a specified future date. For example, if you purchased a corporate bond that has 5 years to maturity and an annual coupon of 7%, then you are guaranteed to receive a coupon of 7% in each of those 5 years. Essentially, you gave the company a loan that gives you a 7% annual interest rate, and your original bond sum will be returned to you upon completion of the 5-year period. The fundamental difference between stocks and bonds. Unlike bonds, company shares have no guaranteed return. In other words, they do not guarantee a predictable cash flow to be paid at a specified future date. When you hold shares, you rely on their market value. When you hold bonds, you have a chance to get the guaranteed return, even if the company suffers financial difficulties. The main points. A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. Unlike bonds, company shares do not have a guaranteed return.
Is predicting your economic future a riddle wrapped in an enigma? Not quite. It's about creating it. Financial practices shared in the earlier segment, courtesy of financial expert Jacob Nayman, are your toolkit for securing that future. But here's the catch. Knowledge isn't the ultimate prize. It's action that truly counts. The upcoming segment aims to spark that drive, that motivation within you to implement these strategies. So take note and remember, in the grand chessboard of finance, it's not the player who knows the most moves, but the one who actually makes them, who wins. This video contains valuable information. Use it.
Ever wondered what the difference between stocks and bonds is? Well, you've landed on the right video. Stocks and bonds are individual classes of investments, each carrying their own set of advantages and risks. But remember, every successful investor began by grasping these fundamental concepts. By the end of this video, you'll not only comprehend the differences between stocks and bonds, but you'll also be a step closer to making informed investment decisions. Firstly, let's dive into the world of stocks. What are they exactly? Think of stocks as a golden ticket to the ownership of a company. Each time you purchase stocks, you're actually acquiring a fragment or a share of that company, making you a bona fide shareholder. Translated in simple terms, you're making an ownership investment each time you buy stocks. This ownership doesn't just make you a part owner of the company, it also opens up the pathway to a share in the company's profits, which may come your way as dividends. To encapsulate buying stocks just a monetary transaction, it's the first step in your journey towards entrepreneurial success. After all, every successful entrepreneur began their journey as a shareholder. So remember, each time you buy stocks, you're not just investing money, you're investing in a future of success. Now, let's talk about bonds. What exactly do they stand for? Imagine this scenario. You're not just a mere investor, but a lender. By buying bonds, you're basically providing a loan to an entity, which could be a corporation or a government. Bonds are akin to granting a loan to a friend, only that this is done on a much grander scale. They, however, come with a fixed timeline and an unchanging interest rate. Therefore, when you invest in bonds, you're not just putting your money somewhere, you're creating and shaping dreams. So what's the main difference between stocks and bonds? Well, the critical factor lies in risk, reward, and the essence of your investment. Stocks are inherently riskier as they involve buying a piece of a company, turning you into a shareholder. If the company prospers, your stocks can take off, providing potentially high returns. Yet, if the company faces difficulties, your stocks are likely to plunge. Contrarily, bonds are perceived as safer options. Here, you're fundamentally lending money, often to a government or corporation. As compensation, they vow to reimburse you with interest. The returns are generally lower than that of stocks. The risk is also considerably less. Remember, whether you decide on stocks or bonds, you're advancing towards financial liberty. To summarize, stocks represent ownership and the potential for high returns, but at a greater risk. Bonds signify lending money with a lower risk and steady, albeit lower returns. But no matter your choice, you're on the journey to success.